In a tight-knit microeconomy like Hamilton, New York, a person's commercial reputation operates like a highly liquid asset. In a small college town of barely 7,000 people, a familiar face and a firm handshake almost always bypass traditional financial due diligence. Burton Marshall understood exactly how to weaponize that local trust. Operating out of a small office on Maple Avenue, Marshall spent decades building a practice as an enrolled agent, a tax advisor authorized to practice before the IRS. This gave him omniscient, asymmetrical access to his clients' financial lives. He knew precisely when a client sold a business, received an inheritance, or rolled over a retirement account. He tracked them to their exact moments of peak liquidity. When a client's bank account swelled, Marshall offered them a deeply localized investment vehicle he called the 8% Fund. In exchange for their cash, he issued 30-day demand promissory notes, mathematically guaranteed to yield 8% a year. The pitch was grounded entirely in physical reality. Marshall claimed the capital was secured by a vast portfolio of rental properties located within 6 miles of his office. His investors could literally drive past the buildings purportedly securing their life savings. By leveraging his fiduciary proximity as their tax guy, Marshall replaced complex financial reality with the illusion of ultimate transparency and absolute security. The underlying reality was catastrophic. A forensic reconstruction later proved that by 2016, Marshall was terminally insolvent. His total financial liabilities exceeded his genuine assets by $40 million, and yet he continued to solicit new capital for another 7 years. This comparative bar chart shows the inescapable mathematical pressure of Marshall's operation. By the time his scheme reached its peak, he owed roughly $95 million in raw principal. To simply maintain the illusion of an 8% yield without actual asset generation, he faced an annual cash obligation of $7.6 million. Conversely, his actual legitimate rental and tax businesses were operating at a massive deficit, generating a microscopic net income of only $20,400. To bridge a multi-million-dollar gap and prevent a run on the bank, a Ponzi scheme relies entirely on synthetic wealth. Marshall directed his office staff to systematically generate fraudulent documents titled transaction summaries. These official-looking phantom statements falsely reported the exact amount of 8% interest investors had accrued. By presenting this paper reality, Marshall convinced his victims their wealth was compounding perfectly, encouraging them to leave their principal untouched and roll over the fake gains indefinitely. Fabricating a transaction summary can delay a client's demand for cash. However, physically moving hundreds of millions of dollars in stolen capital to keep the lights on requires structural complicity. It requires a heavily capitalized banking partner. The physical movement of Marshall's illicit capital was highly centralized. He banked exclusively with Berkshire Bank, routing nearly his entire operation through a single individual checking account, known in federal filings as the 2301 account. This node-based flowchart details how Marshall obscured the stolen money. He operated 6 separate doing business as entities, ranging from local moving logistics to a commercial print shop. He funneled the revenue and illicit deposits directly into his 2301 account, processing $211 million. Berkshire's internal software correctly identified this anomaly, triggering a formal alert every 6 weeks. Then, the automated alerts turned into explicit human warnings. On October 18, 2021, an investigator at NBT Bank, Marshall's former institution, sent an email directly to Berkshire Bank's Assistant Vice President of Fraud Investigations. The email directly named Marshall, explicitly identifying the exact typologies of a massive Ponzi scheme. The investigator warned Berkshire they were tracking massive money flowing to individuals as interest payments, despite Marshall having no license to operate an investment fund. Berkshire Bank possessed relentless software alerts flagging hundreds of millions in suspicious movement, backed by an explicit warning describing the exact mechanics of the fraud. Despite this, the bank's human compliance apparatus chose to look the other way. In civil litigation, holding a bank liable requires proving they provide substantial assistance to the fraud. Instead of freezing the 2301 account after receiving the warning, Berkshire Bank took proactive steps to accommodate and retain Marshall as a high-net-worth customer. Berkshire was closing its local branch in Marshall's area. To ensure he wouldn't move his accounts, they assigned him a dedicated private banker and provided him with a commercial-grade remote check scanner. They granted this heavily flagged individual a daily remote deposit limit of $300,000, allowing him to bypass physical tellers entirely and accelerate the velocity of his illicit deposits. The corporate motive driving this staggering compliance failure was purely economic. During this exact window, Berkshire Bank's parent company was actively orchestrating a major corporate merger with Brookline Bancorp. Deposit accounts are the lifeblood of a bank's lending power. By maintaining Marshall's bloated accounts, Berkshire artificially inflated its deposit base, making the institution a highly attractive acquisition target during the merger negotiations. Faced with a choice between regulatory obligations and deposit retention, Berkshire Bank prioritized its own corporate valuation. They kept the capital, and the scheme survived. The ultimate unraveling of the enterprise did not begin with an SEC subpoena or a whistleblower. In late 2022, Marshall was unexpectedly hospitalized for a severe heart condition that required 2 major consecutive surgeries. Because the fraud was an autocratically managed operation heavily reliant on Marshall's manual intervention, his sudden physical incapacitation broke the liquidity cycle. Stuck in a hospital bed, he missed the mathematically critical interest payments to his investors. The abruptly missed distributions combined with rapidly circulating rumors about his failing health to create an immediate panic in Hamilton. His investors demanded the redemption of their 30-day notes en masse, triggering a localized bank run that exposed the total absence of underlying capital. State regulators and compliance officers missed the red flags for 3 decades. The catalyst that finally brought down a $100 million financial empire was the failing cardiovascular system of a 74-year-old man. The math went public with devastating speed. By April 2023, Marshall declared bankruptcy, filing schedules that revealed a catastrophic deficit of over $70 million. The tangible local real estate he pitched to his victims covered only pennies on the dollar. The criminal fallout followed swiftly. Following a multi-year probe, New York Attorney General Letitia James announced the arrest of Burton Marshall, unsealing a sweeping 49-count criminal indictment for grand larceny and securities fraud. With the fraudster definitively bankrupt and facing prison time, the bankruptcy trustee and the devastated retail investors turned their sights on the enabler. They filed a massive class action lawsuit directly against the newly merged Beacon Bank for aiding and abetting the entire operation. The lawsuit seeks full disgorgement of profits and civil penalties. The plaintiffs are aggressively shifting the burden of financial restitution away from the penniless tax preparer and onto the heavily capitalized, publicly traded banking institution that provided him with a $300,000 daily limit and looked the other way. When highly regulated financial institutions manufacture silence to pad their deposit base, they inevitably inherit the multi-million-dollar legal wreckage when the scheme finally collapses.